All right, everybody, welcome in. Thank you guys all for being here today. Looks like we've still got some people joining in. We'll give it another minute or so while we wait for everybody. But while we wait, I do want to go ahead and go over a few housekeeping rules. So we're gonna obviously be going over the pros and cons of doing some multifamily type of real estate investing today, guys. And we have a great presentation for y'all. So as we go through, if you do have any questions, please put them down in the chat box in the comments, and we'll get to those towards the end of the presentation. We'll have our speakers kind of go over those, and we'll get to your questions at the end. So go ahead and put them there in the comments, and we will certainly get to those, guys. Looks like we still have people coming in, so we'll give it another minute or so. I guess I'll go ahead and give my little spiel while we kind of wait. So my name is Colin Taylor. You can kind of see it there on the slide, but I'm on the IRA specialist team here at Quest Trust Company. I know we always have some new faces, new people kind of joining our webinars. So I'll definitely go over a little bit about us, and then we'll get into the presentation. But I'll go ahead and just kick it off. So today we're going to be going over the pros and cons of private real estate investing and doing this multifamily type of investing. So always with our webinars, we give our disclaimer. So Quest Trust Company does not give any sort of tax, legal, or investment advice. Guys, this presentation is strictly for your education. So please understand that. And, as we go through, keep that in mind. Now, I want to talk a little bit about who is Quest. So we are one of the largest self-directed IRA custodians in Texas, and we have over 20,000 active investor clients across the country. We asset about $2 billion under administration, have about 100 employees with 34 having that Certified IRA Services Professional certification. That CISP certification is actually pretty hard to get. It takes a lot of studying. The test itself is pretty brutal. So that is a very prestigious certification. And then we have about $400 million in undirected cash, which means that our clients are certainly looking to do deals. And that's why we like to have guys like Ivan and like Tariq come on and kind of talk about what they do and just different types of investing that our clients can get into. So if you do like these types of videos, you like our webinars, please, give us a like on Facebook, follow us on YouTube, and you can actually see the recordings of our webinars. And this one in particular will be up on our YouTube just a few minutes after we close the stream. So you can go back and look at our, the other webinars that we've done, other videos that we've done, as well as look at this recording. So as well as some of the other events that we have coming up. So we do a weekly self-directed IRA Saturday class every Tuesday and Saturday, both at 12 p.m. So those happen once every week, or I guess twice every week, Tuesday and Saturday. And we always bring on a new investment expert and kind of just talk about, different things. So please join us for those. You can register on our website, which I will have Andrea or myself put in the comments a link to our website so you guys can follow that. Additionally, our virtual networking happy hour happens the fourth Wednesday of every month. Those start at 6:30 p.m. Central Time. You can register for those on our website as well. Those are a great resource if you're, looking to kind of get more in the space, do some networking, do some deal pitching, things like that. And they're nationally advertised. We have people from all over the country join those. So those are really great resources as well. And like I mentioned before, you can find any of our, classes or anything like that you've missed on our YouTube channel or our Facebook. We post all the recordings on there. One big event that we do have coming up here in just a little over a month, December 9th and 10th is QuestCon. So this is actually going to be not only a forecasting event, but we're going to be doing a market recap for 2022. So it's all virtual. Tickets are, I believe, $70. You can buy them online on our website as well. And the first day, we're going to be doing a market analysis recapping 2022, looking at what trends we saw, and then kind of leading into the following day, December 10th, we're going to be doing forecasting for 2023, trying to give tips, things like that, maybe some tidbits you can take into 2023 that'll help you in your private investing. So we're going to have some panels, Q&A, a lot of experts on there, guys. So that's going to be a really great event. Like I said, all virtual. Lastly, if you do have any questions, whether it be for Quest, whether it be for our speakers, you can certainly reach out to us. We'd be happy to help you any way we can. There's a live chat feature on our website that actually you can interact with any of our IRA specialists. So including myself, anybody else on our team, right? We are on there live, 8:30 to 5:30 Central Time, Monday through Friday. It's a live chat, and we can answer any of your questions on there. You can call us, 855-FUN-IRAs. We'd be happy to speak with you guys on the phone, as well as email, IRA Specialists at questtrust.com. And I'll put my personal email in the chat as well. That way you guys can see that. But yeah, without further ado, I'll go ahead and get Ivan and Tariq in here. And let's see. We'll get Gail's presentation. Perfect. So Ivan, Tariq, thank you guys so much for being here today. I'm really looking forward to the presentation myself, and I think you guys are going to have something really great for our audience here.
Thank you very much. I will. Thanks for having both of us. I will start with just a quick intro of Anthem Capital, cover the agenda, and then dive right into it. So the key for Anthem Capital is to help unlock your wealth potential through real estate investing. And what we do is we help busy high-income professionals, just like a lot of us are, that struggle with making time for what we really want to do, what we really love, what we are passionate about. And we give them the opportunity to invest passively in real estate opportunities, educate them, give them opportunities to invest, and as a result of that, give them an opportunity to unlock their wealth potential, and as a result, give them freedom to do what they want in their lives and create a lasting and a positive impact in their community. So today what we wanted to cover was just do a quick intro for both Ivan and myself, and then get into what the pros and cons. We'll get into cons first and then get into pros of investing in real estate, and specifically investing in multifamily real estate is what we are focused on. So Ivan and myself started Anthem Capital a number of years ago. We have been working together in single family space for a number of years before starting in multifamily space. At one point we had quite a large portfolio of single family investment properties, which we got out of and have transitioned over into multifamily. At this point, we have several thousand that we have syndicated as sponsors, and then we invest passively as well. So between the Ivan and myself, we have close to 15,000 units that we are either sponsors in or invested passively in. I myself am more involved on the acquisition, disposition, and refinancing side of things. And I'll pass it on to Ivan for his intro.
Thank you, Tariq. Good afternoon, everyone. Excited to be here, and thanks for the opportunity to share why we favor multifamily investing. A little bit about myself and my background. I come with a 20-year history in the Air Force, and a lot of what I learned in my Air Force career I definitely leveraged into the multifamily career that I am pursuing today. I started off single family investing, as Tariq mentioned, buying these little single family homes around these Air Force bases that I was stationed at, but quickly learned the power of multifamily investing. And now this is solely what we are focused on. And my primary role in Anthem Capital is to oversee the execution of the business plans that we present to all of those who invest with us. and ensure we have smooth execution operations to basically meet or exceed our projected investment returns that we advertise for each of our investments. You can see there at the bottom of the screen that we have taken time to make sure that we are a credible company, as also depicted on our website, anthemcp.com. You can see you're part of the Better Business Bureau. Tariq is part of the Brad Sumrock ecosystem and is a certified instructor with Brad Sumrock. We're compliant with the Fair Housing Compliance certification, as well as the National Affordable Housing Management Association, as well as NMHC, as you see on the screen there. Tariq, I'll hand it over to you.
Very good. Just wanted to quickly cover the track record that we have for the assets that we have syndicated or our general partners and sponsors in. We have acquired over 20 assets in the period that we have been in multifamily space. Ivan and myself both are in Oklahoma. That is where we started out and initially started purchasing in this state. At one point, we had 6 assets in Oklahoma State. Those are all sold at this point. We had a couple of assets in Little Rock, Arkansas. Those are sold as well. We have sold 13 assets that have gone full cycle at this point. There are 2 more in our portfolio that are currently under contract to be sold and should close here in the next few weeks. The average across the portfolio, and what you can see here on the right, we have broken down for every single one of these assets what kind of returns, what the holding period was, what the size of the asset was, and what kind of return we were able to achieve. Average across the portfolio for the deals that we have exited at this point, average annualized return is in the high 20s, about 27-28%. The average annualized return is in the mid-20s, about 24%. Very strong IRR and very good equity multiple of close to 1.7, 1.8, meaning about an 80% return during the holding period. Our holding period, although we underwrite with a 5-year plan, but it has typically, just because of the strength of the market in recent years, has averaged around 3.5 to 4 years. So that there are, this chart gives you an overview of the various assets that we currently hold in the portfolio, and our current holdings are more focused on concentrated in the Dallas-Fort Worth area. We have one in Phoenix, one in Orlando, one in Salt Lake City, and then a couple in Kansas City, which is a market that we have recently entered into in the last year.
All right, I'll start off the presentation now to first open up with a set of cons that we need to make sure we think through and understand before jumping into multifamily investing. And not only cons, but understand the risks that you will be getting yourself into as you look into multifamily investing. And some of you may on this presentation, this may be your first time investing in multifamily or considering it, or there may be more seasoned vets that have looked at this type of alternative investment before and have already gone through some of this analysis here and understanding the risks. With that being said, the first con we would say is, we want to discuss here is time. These investments take time to appreciate. They take time to create cash flow. They take time to develop and for you to be able to realize a significant return on your investment. It's not a get-rich scheme and not a get-rich overnight scheme. You have to be patient and be willing for these investments to grow and evolve over time. If you have a long-term mindset as you get involved into multifamily investing and have a long-term mindset and expectation, then it will meet or exceed your expectation, because these are very profitable and projected profitable investments to be in. But just understand they take time. Tariq said on average it's 3.5 years our holding period, but we underwrite to a 5-year period, and it may take up to 5 years to be able to realize the projected returns that we are advertising. All right, next slide. Right, liquidity. So unlike the stock market or maybe a CD or bond or some type of other more liquid investment, once you put your monies into these deals, it's very difficult to take it out. You have to be willing to part ways with your investment and allow your investment to go to work for you. And so it's somewhat of an illiquid investment over time. And you have to just basically be willing to let it develop and grow. But another piece to liquidity is like any business proposition or business operation, there may be ups and downs or challenges that that asset may experience over time, in which perhaps your expected cash flow is not arriving when you expect it to arrive. For example, during COVID-19, if you recall, we didn't know how the market was going to react. We didn't know how tenant behavior was going to react, where they weren't allowed to leave their homes, or maybe there was some job loss or an increased unemployment. Were they going to pay rent? And so that during that time, we had to stop our distributions, pool all of our capital, and preserve it to ensure we can sustain operations until we had clarity in seeing how the market was going to react. And so those assets that we were given distributions, we had to stop, which means you were no longer receiving cash flow distributions and thereby hindering the liquidity of that asset. And so that is something just to be aware of and understand that those are those risks that you have to be willing to take, and also plan in and budget within your ongoing personal finances, and realize that you may not, it's not a guarantee to receive a cash flow distribution every quarter, every month, for example. All right, next slide. All right, location, right? So this is a very pretty straightforward thing that we need to realize here. First of all, you need to build a deal from the ground up, and you can't invest in every single apartment. You can't go and buy every single asset. You have to be smart in where you purchase these assets, and only understand the ground level on what is occurring with that asset, meaning in the local submarket in which you're buying that apartment, but also at a macro level. Are you buying a location that has positive rent growth, positive population growth, positive job growth, etc.? So when we say location, it means you cannot buy at every single location. You have to be very selective and disciplined about that, and ensure you understand the inherent risk located with each submarket that you're buying in. For example, we bought in a very tertiary market, North Little Rock, back in 2018 with a lower median household income. But we bought that property at $18,000 a door and ended up owning it for about $25,000 a door and selling it for $50,000 a door about 3.5, 4 years later. Yes, it was maybe an unfavorable market compared to a Dallas market, but we understood at the ground level how to operate that asset. So if you're willing to take the time to understand where you're buying these assets, you can maybe overcome some of these inherent risks, perceivable inherent risks as well. All right, next slide.
Okay, I'll go over the next couple of these cons that we have. So there's no easy way to say this. You need money to make money. So starting out, just looking at a high level example of, we typically look at properties that are at least 100 units in size, 100 apartments in size. So these in a primary growing market are probably is a property, let's say 150 to 200 units might cost about $30 million. So for that property, for us to acquire that property, let's assume we are able to get a loan at 75% of the value, so which would leave us with about $7.5 million in equity that we need to bring to the table to be able to acquire that asset. So that is where we as GPs, as sponsors come in, where we go out, we identify the asset, we find the asset, we do all the homework and the research in terms of the submarket, the positives, the negatives, the location that Ivan went into, all of those things. And then we syndicate, we raise equity, the $7.5 million that is needed from individual investors. So typically somewhere between 50 to 100,000 minimum for each one of these acquisitions. So if you have $50,000, then you can participate in one of these acquisitions as a limited partner. And as we went over some of the track record and the average returns that we have been able to realize in properties that we have taken full cycle. Right now we are looking at a 70-80% return or higher return over a 5-year hold. So that is the kind of return that you would be looking at. Now, again, you would need at least $50,000 minimum for you to be able to invest in one of these acquisitions. If funds that you have at your disposal are even a lower amount than that, then there are other opportunities like REITs or other funds that you could invest in, which would take a smaller investment amount. So it's very important to understand that there are going to be things that you have not really accounted for, things that are going to hit you out of the left field. Every single one of these acquisitions that we have done comes with its own set of nuances, with its own set of problems. And the best way to try to circumvent running into those issues is just being very cautious upfront, doing a lot of diligence upfront, doing a lot of research, ground level research upfront, which is what we try to do for every single one of these acquisitions. Going into markets that are growing strong markets, positive growth, positive job growth, positive income growth, positive population growth, going into markets that have legislation, rules, regulations that are that favor landlords versus tenants. So as you have these assets, you would always have tenants that are going to not pay rent. So you are going to go through an eviction process. You want to make sure that you are in markets where you can go through that process in a timely, quick manner. Then you want to make sure that you are getting insurance coverages that are appropriate, where there may be loss of income. If there's fire at the property, you have several units that go down or are not in a rentable condition for a period of time. So you want to make sure that you have insurance that is in place that can cover that. And then making sure that you are or your property management company is doing the appropriate amount of diligence to really bring in the tenants, the right kind of tenants. So a lot of these problems that you run into can be avoided by doing a lot of these upfront items, addressing a lot of these things upfront. With that, let's having covered some of these cons, let's look into some of these pros of why it is good to invest in real estate. Ivan.
Yes, absolutely, Tariq. And just to summarize again on the con side before we jump into the pros, first, again, make sure it takes time for these assets to appreciate. Relatively illiquid assets, and you won't be able to pull out your funds until you have a capital event like a cash out refi or sell. You got to be careful in the location that you're buying these assets in. Require a significant amount of money up front. But with all that being said, if your operators, if those you're investing with have very conservative underwriting practices and principles, are able to convey that to their investors, you can mitigate a lot of these risks and these cons through those practices. So with that being said, hopefully everyone's still with us. We're going to move on now to pros and talk about why we're excited about multifamily investing, even in today's environment. All right, so first of all, it's easy to understand, right? There are tons and tons of books, tons and tons of information these days out there in the airways on YouTube, plenty of Amazon books, plenty of mentorship programs you could be a part of. Once you start attending these, if you have not been educated yet, you'll start to catch the patterns of things you need to understand if you want to get smart in multifamily real estate investing, either from a passive point of view or also from an active point of view. And that's why I like it. I mean, you're looking at someone who flew airplanes for 20 years in the Air Force. I didn't understand anything about multifamily investing. And because of a mentorship program, 9 months after joining, we bought our first property portfolio, 214 units, 65, a 50 unit, and a 99 unit in Oklahoma. And that was a relatively short timeline to be able to go into our first acquisition. So if you can learn whatever career that you're in, you can learn this business. Next slide. Passive income. I mean, this is amazing, right? This is why we do it. It's truly passive investment. I mean, of course, you want to take the time to vet the operators. You want to take the time to vet the deal. You want to take the time to understand what it is that you're investing in and ensure that the assumptions being conveyed to you are appropriate assumptions and the operators are able to support those. But once you have that comfort factor in place, once you have clarity on why you want to invest with someone or into an opportunity, then it's truly passive. It's simply you can watch and oversee, or you can fire and forget, right? I mean, you can still be involved and make sure you read the monthly reports, or you can be on the KPI calls. But a lot of our investors, we don't hear from. It's truly a passive investment. And then you can leave it to the experts to make sure that they're putting your money to work and overseeing your money in an appropriate, responsible fashion to ensure that they're able to produce the passive income that they projected to you in the opportunity. All right, next slide. Leverage. Leverage, leverage, leverage. I mean, first of all, you have to understand debt. And debt allows us to buy these large assets, huge assets, and buy them at very little relative money out of your pocket. In today's typical market, the leverage amount is coming up, but it was all the way down to 50%. It may be up to 65, 70% here soon. But think about it. You're buying, say, a $50 million. You could buy a $50 million asset, say at 80% leverage, maybe around $10 million out of pocket. That gives you the purchasing power to go out and do a lot of good with the money and make the money work for you versus you work for it. And that's why we love this business. And not only are you leveraging money, leveraging debt to realize a higher return on your investment because you're putting less money into the deal and get a greater return, thereby a greater return on your investment, but you're leveraging each other. Through these syndications, through these funds, we're able to pool investments to go out and purchase a bigger asset and more of something to produce a better and bigger return. And then you get to leverage yourself into all the additional benefits you're going to see here in a minute. And there are 6 to sum it up real quick. It's the cash flow benefit, the principal pay down benefit, the capital gains, the equity capture, the tax savings benefit, and then the forced depreciation benefit, all by way of leverage. So not only are you leveraging through debt, you're leveraging each other, leveraging our experience level, leveraging track records, leveraging other people's expertise in these deals, and leveraging property management companies and their ability to be able to asset or manage these assets as well. Okay, next slide. Okay, I will cover the next couple of points here on the pros. So as you invest in one of these assets and own part of it, there are a couple of ways that the value increases. There, of course, is appreciation that is going to happen, that should happen over time as you are holding the asset. But as you hold the asset, you're making debt payments for the loan that was taken on, and as you make the debt payments, the part of that is going towards the principal. So your equity ownership in that particular asset is going up over time. So if you're holding the asset 3, 4, 5 years, you have paid down the debt to some
level, and on top of that, hopefully there is appreciation, there is increased net operating income, there is increased value of the asset. So by way of that, the equity that you have in the asset increases significantly. Tax benefits. So this is significant. This has been a huge positive for us in multifamily investments for the last several years with the revisions in the tax code that were done in 2017, early 2018, where there was accelerated depreciation that was allowed for multifamily assets. And what that allowed us to do was that for $100,000 that was being invested in one of these investments, you would typically have a loss in the very first year, a paper loss, a tax loss of about 60 to 70,000, maybe even more than that. And that will offset any of the gains that you're having from that particular investment or other passive investments that you might have. Now, just want to make sure we are not tax professionals, we are not CPAs. This is just our personal experiences of a lot of our investors that I'm just sharing with you guys, that this has been a significant benefit for us from a tax standpoint, and our taxes have significantly been impacted favorably for us, where we have been paying lower taxes because of this accelerated depreciation. There is also the possibility of doing a 1031 exchange and to further push out when you pay taxes, when you realize the gains and pay taxes on your gains. It is not easy to do in the multifamily space because there is a large number of investors that are coming together in any one of these acquisitions, but we have successfully done it in a handful of our assets where we work very closely with the investors going into the disposition, the sale phase, and if there is a large majority of the investors that have an interest in doing a 1031 exchange, then we will facilitate that and do that. And we have successfully done that, as I said, in more than one instance. So this is, then there is also the benefit of that when you are holding the asset for a number of years, then the gain is taxed as a capital gain and not as ordinary income, and your tax rate could be lower because of that as well. So there are multiple avenues by way of which you can really achieve significant tax benefits by investing in real estate. Considering the times that we are going through right now, high inflation, interest rates that started going up several months ago and keep continuing their upward trend, this is investing in real estate is a hedge against inflation. In these times, you want to make sure that you are invested in assets that give you that hedge, and real estate is one such investment. As inflation continues to go up, the cost of living continues to go up. We, in multifamily investments, as multifamily owners, as investors, the leases, the rent agreements that we have are 6-month or a 12-month lease rent agreement, and we have the opportunity to reset what we are charging on an ongoing basis for a particular apartment every so often. So we are able to capture the increases in the cost of living. We are able to capture the inflation, the impact of the inflation, and increase the rent. The rent growth in the markets that we are in has been very, very strong over the last couple of years, especially the last year. So, we have the opportunity to increase rent, and then inflation as that, is there, that also drives up the value of the asset. So you have a positive both by way of increasing the value of the asset because of the income going up, but by also because the value of the asset is going up because of inflation. This is a very stable investment. Ivan talked about it earlier that this is a longer term investment. This is not something that you are going to look at for a shorter term. It is a longer term investment, but it is a very stable investment. It is as stable an investment as you could find out there in any investment opportunity. The return risk ratio, the reward ratio that we have for this particular asset class is significantly higher than any of the other investment opportunities. We have studied both residential and commercial investment real estate space in depth, and in multifamily space, especially the working class investment space, where we are providing housing to the working class people. That is by far the most stable investment that you can be in. People always need a home to stay in. As inflation goes up, as the interest rates go up, that the affordability gap that is there, that has gone up significantly now over the last year, where it has become more and more difficult for individuals to own a home, which pushes people to continue to rent a unit, and that just continues to push rents up. So these tailwinds that are there continue to be very strong, although inflation and higher interest rate environment that we are in is here for some period of time. But the affordability gap and the supply-demand equation or imbalance that we have been in for some period of time will continue to have a result in very strong tailwinds for this particular asset class.
All right, the next one here is cash flow, man. What is this? Mailbox money, right? So you put your investment into a deal, you leave it to the operators to go and execute that business plan by way of improving the property through interior improvements, exterior improvements. As you improve the interiors, improve the exteriors, you then can charge a higher rent for that same interior unit, which means a rent bump. And as that multiplies over time, it creates more cash flow, right? And guess where that money goes? Right to your mailbox, where you don't have to be the person making sure that you can improve those units in time, making sure the materials show up on time, the labor is there, and deal with all of the headaches that goes on in operating one of these properties. Essentially, we're buying businesses. Each of these apartments is a single business, and we have to create a profit. That's the operator's job. That's their role. That's their fiscal responsibility to create cash flow. But that cash flow is a benefit. It's an income stream that you can that you will realize, and it's nice to open up our bank accounts and see it grow without us even being involved in the middle of all of these operations that are going on with our own passive investments, in addition to the ones that we invest with in our own deals. Typically, from a 5-year standpoint, the cash flow is relatively low in the first year because you're incurring economic loss or vacancy loss because you're taking down units to improve them, so you're not realizing as much rent. But as you get stabilized and you bring the occupancy back up, that's when your cash flow continues to improve, and you start seeing additional distributions to your inbox, anywhere from, say, 6 to 10% cash on cash distributions. And a lot of the offerings you see today provide a pref, say a 7% pref, which means the investor, the passive investor, will realize their return, their 7% return, before anyone else can take a cut on any future distributions. So that gives you the preference to realize a return on your investment and incur greater cash flow into your inbox. The next one is appreciation. To me, this is one of the key reasons why I love apartment investing. Tariq touched on it a little bit already, is inherent with what is going on in our markets today, with affordability crisis going on, it's becoming more and more difficult for first-time home buyers to purchase their home especially now with rising interest rates and supply and demand issues, where you cannot make enough of these housing units for people to live in. Thereby, limited supply, increased demand means prices go up. And these people have to live somewhere. So they then turn to the apartments that we're buying and operating. And so there's more people having to move into these apartments. Well, what does that do? That creates more demand for our housing units at our apartments, which increases rent, right? Naturally increases rent. Another thing is all the liquidity in the market still out there. A little bit different than what we experienced in the previous recession. There's a lot of liquidity out there. Maybe it's standing on the sidelines or waiting to see the correction taking place. There's a lot of liquidity chasing these assets with limited assets. That creates inherent compression in light of the interest rate environment that we're experiencing. Another thing, though, is this forced appreciation characteristic to a multifamily investment, which is beneficial compared to a single family investment. What am I saying here? We're at the controls of these assets. We get to control the growth, the appreciation that this property will realize. And how do we do that? Through our sound operations, through the execution of a business plan, making sure we can turn those units in a timely fashion to realize our rent bumps in a timely manner to make sure we get our rent growth earlier than later. We're at the controls of these assets. We're in a stock. You don't know who's controlling that asset. You don't know where is that value actually coming from. But these assets, you're connected directly to the operator. They will tell you exactly what they're doing to this property to create a profit. You're seeing with your own eyes through these reports. And even if you go to the property, I mean, if you're a good operator, you're going to be open book and you're going to let your passives come in and realize behind the scenes what is going on at each of these assets, right? You can see the forced appreciation taking place, and also over time, the NOI should grow, which means we're improving the operations over time. Over time, it does take, there are ups and downs, but over time, you should see it grow. Let me give you an example. So the forced appreciation model, I mean, we bought an asset in 2019 in Lancaster, Texas, just south of Dallas for around 11.7. And just over 3.5 years or so, we sold it for 19.5 and realized a 45% cash on cash annualized return, 35% IRR. That was through the implementation of the business plan, in addition to the natural appreciation that takes place, which I already explained. And that's what makes this so powerful compared to a single-family single-family residential property, where the value of those properties are determined by the comparative market analysis. You cannot force depreciation. It will be capped at a certain level, where these type of assets, you can continue to raise the value by being at the controls and making sure you're properly executed business plan to create that additional value. And that's why I'm very excited about multifamily investing and how I'm able to leverage, again, a lot of my military operational experience into what we do today. So with that being said, that wraps up our presentation talking about the pros and cons of multifamily investing. Hopefully you are able to glean something from this, and we'd be happy to answer any questions that you may have on this presentation. In addition to that, we want to provide something for you guys, an opportunity to learn more about what it is we do on a day in, day out basis. We have this simple book for you to read. Now, listen, you can go to Amazon, you can buy it, but we just want to give it to you for free right here. And the way you can get a copy of that is simply put your phone up to this QR code, take a scan there, send out your information, and we'll give you a direct download to this book. It's about a 90-minute read. It's not a long novel. Hopefully it doesn't put you to sleep at night. You'll gain some additional information on how you can unlock your wealth potential through real estate investing. Thank you for this opportunity, and we'd like to, I guess, now open the floor for questions.
Yeah, absolutely. Thanks, guys. That's an awesome resource. I'm actually gonna scan that and utilize that myself. What a great tool Thank you guys for speaking and for sharing all that stuff with us. But yeah, we can certainly jump into questions. I see there's one right here from Neil that says even in an IRA. So Neil, if you could expand on that a little bit. Not sure. I mean, I'm sure it made sense when you typed it in regards to what they were talking about at the time. Yeah, guys.
The question might very well be whether you can invest in these opportunities through an IRA, right?
Okay. Yeah, that's what. Tax benefits. Okay. So yeah, can you utilize an IRA to invest in these apartment syndication deals? Absolutely. And I'll say it's one of the hottest investments right now that we see our clients doing is investing with these syndicators and investing in apartment buildings because it's a hot ticket right now. So yeah, absolutely. You can do it through the IRA, receive those tax benefits, whether it's tax deferred or even potentially tax free, just depending on what the tax status of your investment funds are. Do you guys have, Tariq or Ivan, have anything to add? Or?
Well, just, the fact is that the reality, just based on our experience, probably about a quarter of the investors that join us in any one of these acquisitions are investing through IRA funds. So there are quite a few that invest in, and Quest is one of the leaders in that space. So a lot of people have their self-directed accounts with Quest and are investing through that, and just those tax benefits are real and they can be applied realized in the IRA, the self-directed IRA accounts as well.
Absolutely. What other questions? Do you guys have any current deals or anything like that you'd like to share?
Yeah, thanks for asking. We still have a 506c accredited investor opportunity, so we can share it publicly, given the 506c status of our investment is located in Fort Worth called Arriva Apartments, which is what's key about this is now we're in Q4 of the year. A lot of us here may be doing analysis to see what our potential tax liability will be for 2022 taxes. Well, with this investment opportunity, which is a value add, 1978 build, 165 units or so. What's significant about this is through a projected cost segregation report, we're projecting about 107% bonus depreciation opportunity. What does that mean? 107%. So you put in $100,000 investment. If you're a real estate professional, you can realize about negative $107,000. I said you put $100,000 into the investment, you can realize a negative $107,000 loss, paper loss on your K1s, which should significantly lower your overall tax basis and thereby lowering your potential tax liability. So it's a great opportunity for that. Time is running out. By end of the year, with this opportunity won't be there anymore to realize that tax savings. So if you'd like to learn more, you can send us an email. You send me an email if you want to write this down. Ivan, IVEN, at anthemcp.com. IVEN at anthemcp.com. If you're curious more about the Arriva investment opportunity, happy to share. We have a full presentation, webinar, slide deck, full underwriting analysis. We'll unpack everything for you to get you comfortable with the investment opportunity outside of this presentation.
Awesome. And I'm just putting that your email in the comments so people can refer back to that.
Awesome.
I'll just quickly expand on what Ivan said earlier, that this opportunity, there's a time frame on this opportunity to realize these accelerated depreciation tax benefits. In this particular case, over $100,000 loss for $100,000 investment, which then can offset any passive income that you are realizing from any of your real estate investments. But this year is the last year that all of that accelerated depreciation can be claimed. That starts going down in 2023. So instead of realizing 100% of whatever the accelerated depreciation amount is, it's going to start going down to 80% in 23, and it keeps going down by 20% every year until it runs out and there is no accelerated depreciation in another 5 years. So this right now, it's a great opportunity to actually realize a tax loss for your taxes with 2022.
Awesome.
Absolutely. Very well said, Tariq. Any other questions out there in coming from the comments? No. All righty. Okay. Well, thank you guys all for being here today. I hope you really enjoyed the presentation. Again, Tariq and Ivan, thank you guys, and thank you everybody from Anthem for being here. You know, providing this presentation, this education. I know it's really helpful for our clients and the people that we have come on our webinar. So I just want to say thank you from Quest.
And we thank you. Thank you for the opportunity. Look forward to connecting with anyone else on this presentation that hasn't had a chance to maybe drop their question just yet. Feel free to reach out to me, ivan@cb.com. We'll answer those questions as a team here on the call. And also make sure you get your free book.
Absolutely, guys. And like I mentioned, we'll have this recording up on our YouTube here in just a few short minutes. You'll be able to see Ivan's email there in the comments as well. So yeah, reach out to them. If you have any questions for me or for Quest, reach out to us. And yeah, we'd be happy to help you guys. Any closing remarks? Any last minute details?
I think I just covered it all. So
awesome.
Get your cash flow.
Yeah.
Right.
Thank
I
you
would
guys.
just say that the book it's as Ivan said, it is a quick read. It really is true synopsis of our real experiences of what we went through, and we just tried to summarize that and make it easy for someone that is exploring the space. So it's a quick read. Just download it, go through it, and come reach out to us, and we'll answer any questions that you might have.
Great. Well, thank you everyone again. Enjoy your Tuesday and enjoy the rest of your week, and we'll see you guys hopefully on Saturday.